Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. We have another great episode for you today. Our guest today is a fairly new investor. He got into the real estate investing world, the commercial multifamily space, about 4 years ago. And over the last 4 years, he has acquired roughly 10 different assets through 6 deals and totaling just over 600 total units and a valuation of about $63 million. And a lot of that he's accomplished in the last roughly 18 months when he went full-time real estate investing, left his corporate career, and went full-time real estate investing. So I had a great conversation with Preston Spainhour today. He talks to us a little bit about getting into the space, how he broke into his first deal. He also talks about his focus on longer term hold periods where they're looking to acquire assets that they'll hold on a 10-year model with the goal of refinancing 100% and giving 100% of their investor equity back in years roughly 4 through 5. And so his goal is to acquire these assets, add a lot of value through renovations and operations, and then looks to refinance in year 4 or 5, and then hold with his investors for the duration of the 10-year hold period. So we talk about that. We talk about the charity that his business is tied to and how they focus on building wells in third world countries to provide clean water. And how attaching himself and combining his efforts with this charity to his investing business has had a positive impact on his business and his investor base. We also talk about his remote investing strategy. Instead of focusing on his backyard, investing in multiple markets across the country with an emphasis on markets where he has good boots on the ground partners in the form of joint venture partners and also property management partners, and how he goes about developing those relationships and finding those partners for each deal. So I really enjoyed my conversation with Preston, and I'm excited for you to have an opportunity to listen to it. So without further ado, let's dive into the show. Mr. Preston Spainhour, welcome to the show. Appreciate you coming on.
Yeah, thanks, David.
So, as usual with our guests, we like to sort of get some background about you and sort of your backstory, what you were doing before you got into real estate. You're a young guy, so maybe you dove headlong into real estate. But talk to us a little bit about your background professionally, school-wise, and then how you got into the real estate space, and we'll sort of go from there.
Yeah, so Olympic hopeful and shotgun shooting, and that was back in college. And so started there, tried to figure out how to pay for it as a college student. It's not the cheapest sport. Got into disaster response, hazmat consulting, and parlayed that into construction consulting, post-hurricane rehabilitation. And it was intense. It was 2 days off a year, 7 days a week was the expectation, 90-hour weeks. And so money was great. I knew it wasn't sustainable, wanted something where I had more ownership and equity, and read about multifamily and studied for a few years and then dove in and ended up, I went full time about a year and a half ago.
Okay, great. So, as I mentioned in the intro here, you've acquired roughly exactly 6 deals, 10 properties total. A couple of those were portfolio acquisitions. Roughly 670 units total and about $63 million in value, all within a year's time, or were some of those acquired as you were sort of building up to going full time?
Yeah, building up to going full time. So it was over, I guess, about 4 years at this point, 3 to 4 years.
Great.
And yeah, it was tough sledding the first couple deals when you're balancing part-time, full-time, and just trying to get it off the ground and do right by the early investors, the ones that believed in you before you had the track record. And so that it's almost like the brake's been let off since since I exited the corporate job. My business partner did the same. And yeah, it's a lot easier when you've got another 90 hours a week to play with.
Yeah, for sure. So I'm always curious about sort of that first entry into the space. And you mentioned reading a book that sort of exposed you to the idea of investing in commercial multifamily. Had you done any investing earlier than that in real estate, or was going straight into commercial multifamily your first foray into real estate investing?
Yeah, it was. I had dabbled, I would say, and I grew up around it. So parents were developers, just as a hobby, and they were both career attorneys, developed condominium, single family neighborhoods on the side. I saw them really get bid in '08, and it was just symptom of the market and their asset class. Condominium lending changed pretty dramatically, and they were delivering their first set of units that week that the
Mm,
crash really started. And so I my lesson learned was recourse debt, take it for what it is, and appreciate it. And then the second piece was just cash flow. And so I started studying, trying to figure out, how do you invest for cash flow, and multifamily was the, I guess, widely accepted or advertised asset class, and at least in the circles I was looking at. And yeah, read Rich Dad Poor Dad, Michael Block's book, a handful of others, and then just started binging podcasts. And one thing led to another. We joined a paid mentorship community, and so that was Tim Bratz's group. Um, it really helped us understand how to find deals, and I think
mm,
that's what he's good at. And so we studied and looked and learned underwriting, and then eventually found something that worked. And it probably took us 6 or 8 months to find a deal that penciled,
mm.
and then we partnered just for confidence and a little bit, just a little bit more ease of execution.
Hmm. And just to give our listeners some context, where are you based out of?
Arkansas.
And the portfolio that you currently have, roughly 10 deals or 10 assets, where are those located?
Texas, Nebraska, South Dakota, and I guess that's it. We have pretty good coverage. So Houston, Corpus, and Rockport, which is a Corpus suburb, and then Dallas.
And so, talk to us a little bit about getting into the space, um, and not necessarily investing only in your backyard. Did you start looking in your own backyard and then expand beyond that? What was sort of your thought process around geographic focus?
Yeah, I think we looked at a couple metrics that really resonated with us early on, and so it was the price per door relative to kind of what asking or market rent is. And I just saw there was a lot larger, I guess, value disparity in my home market. It's undersupplied, very overbought. I felt like, relative to Midwest or some of the secondary markets in Texas. And so we just said, if we're going to eventually have to learn how to invest remotely, why not do it when we don't have a large number of assets eating bandwidth up, and have a little more freedom to test and just learn process and develop. So started out in Corpus, and then got comfortable with that. I think management is a big piece. Management and construction are really the two factors with remote investing. And we like to have boots on the ground wherever we're investing. So if that's not immediately available on the ownership team, we'll go find whoever that person is. And sometimes it's property management recommended, sometimes it's from mentorship groups. We'll just ask around and say, hey, do you know anyone you would trust to be boots on the ground in this market? And it doesn't take asking in too many groups to find a couple candidates.
And give us a sense of what your previous acquisitions, the asset type, maybe just description of the class and type, and vintage, and then are you still looking for that same type of asset, or that has that adjusted with time at all?
Yeah, I think we probably chose the most difficult path we could have starting out. We did heavy value add,
Mm.
and that it was just the deal that penciled, and it penciled well enough that we felt comfortable with it. We brought a contractor onto the GP as part of just a risk mitigation practice on that deal. But yeah, I would say having been through that, one of the things that I didn't expect, and I've since read it in books and know to expect it now, is when you walk into those, the I guess very deferred from a management and a maintenance perspective properties, you there's a very high risk that the tenant base walks, or the majority of them do. And so we walked into a 65-ish% occupied asset, and within 2 weeks it was 20.
Mm.
And that was not expected. It changes pressure on construction timeline and just process. And so it definitely expedited a lot of things. It expedited me leaving the job, expedited us learning construction lending and how to work with bridge lenders, and just the learning curve, I think, sped up as a byproduct of that deal texture. But I would say now it hasn't changed buy box for us. I think we're a lot more careful with construction partners and with property management now, having lived through that. And I think we also appreciate 90+% occupancy at purchase a little bit more than I did back then.
Yeah, I can imagine. So yeah, talk to us just real quick. Describe the vintage of the previous acquisitions, and just a construction type, that type of thing, just to give our listeners some perspective.
Yeah, so first was 1981, and we've since gone newer and older than that. We own a property that was 1800s built, and it just came as part of a package. It was a fourplex on the same parcel as another 28 units that we liked and we were buying. But I think you learn, that's one of the things that you just don't know any better coming in, but you learn to appreciate the 70s, 80s, 90s built assets, and you learn to compensate for anything 60s or newer. And a lot of times where we see that play out is just AC maintenance, and it's the mechanicals. The plumbing actually is a little bit inverted. Those older assets can oftentimes have better sewer lines than stuff built in the 70s and built in the 80s. But you just learn where to look and what to look for. And it's absolutely different, just dependent on age of assets.
And you mentioned the importance of having boots on the ground and how, management plays a role. You've talked a little bit about the importance of really having your buy box identified, or at least focused on where you have good property management relationships. Talk to us a little bit about the importance of property management to your business model.
Yeah, I think it's everything in remote investing, and it's a combination of just the trust to operate the assets and problem solve on the ground when I can't just pick up and be at the property in 10 minutes. And there's also just the interaction and the relationship between your construction team and property management. And so in a perfect world, they're integrated or under the same roof. And if they aren't, we need to have just the measures in place to be able to monitor that and find comfort or work our way to a place where we're comfortable, letting go of the reins a little bit and having them work together. And so I, if someone asked me, what's our buying criteria at Well Capital, it depends on the market. Nationally, it would be 100 doors or larger, and we have a property manager that we trust on any asset that size nationally. But there are markets where we will go smaller. And so like in a Corpus Christi or Sioux Falls, South Dakota, Lincoln, Nebraska, et cetera, if we have a property manager that we trust that is integrated with our systems and they can manage down to 10 units or down to 25 units, then that would be our bottom end of our buying criteria in those markets. And it's something that we've developed over time. And the way we've developed it is when we find a property that piques our interest and is outside of our traditional buying criteria that we're built for, we'll go find a partner who has had success in that market and do a joint venture. And we get access and visibility of their systems, their property management. And we know that asset and that business plan is in good hands with a team that they've already cultivated and battle tested in that market. And then moving forward, we can choose to use it with them, use it on our own. I mean, property managers are public companies. And so a lot of times it's the operators that I've worked with are the good ones. And in our experience, they're going to take equity that they don't feel like they can contribute enough value to earn. And so if there's a need for them, and this is how I approach partnerships, absolutely we'll be there if it's justified. But if there's a deal and you're just partnering because you partnered last time, that's not a great reason to do it. And you just aren't going to have buy-in from both sides. And so we've seen that. And the people we work with, there's not a whole lot of ego to overcome on future deals.
And have you found, you mentioned joining a mentorship, paid mentorship program or group. Have you found that that's your best resource for identifying boots on the ground partners or property management referral partners, joint venture partners in your deals?
Yeah, I think it's network and it's been cultivated from a combination of mentorship groups and meetups and the like executive mastermind events, those sort of things. And so we'll meet people and you see who follows up with you after the event and who do you hit it off with. Like my test for how I vet partners is, do you see yourself enjoying a week-long vacation with them? And if the answer is yes, then I'd be excited to jump into a deal with that person. And if you're hesitant, then I think you have to operate kind of according to that gut feeling. But yeah, I I'm hesitant to just wholeheartedly embrace the mastermind or mentorship approach solely because I think a lot of people join those groups and that becomes their entire business plan and that becomes like the
Mm,
end all be all. And for us, I think part of the reason we've had the success we've had on the timeline we've had has been that we didn't walk into any one group and say, okay, this is the path and these are the only levers I can pull and they work one direction and that's it. We cherry picked what we liked from different groups that we had exposure to and different partnerships that we worked in and said, okay, these are the things that work. These are the things that our systems could benefit from,
hmm.
and just try to add to that every couple months or every deal.
Yeah, makes sense. So we talked a little bit before we started recording about your business model, which is more of a long-term hold, a 10-year model with the goal of refinancing, and ideally refinancing 100% of your equity out and holding long-term with your investors for the remaining duration of the 10-year hold, roughly. So hopefully I gave your strategy, an accurate description. But maybe why don't you just tell us a little bit about sort of your philosophy of the more of a 10-year hold period with the refinance?
Yeah, I would say we like to say it's by investors for investors, and we're LPs in all of our deals too. That's how our deals are structured, and so we we came up with the 10-year model because I think if you look at sponsor compensation, 90% of it's tied to the exit. And so sponsors, just by nature, we're incentivized to take a property to exit, get our big check, and then roll to the next one and make new fees and new splits on the same dollars. And so we looked at that and just tried to reverse engineer, what would a deal have to look like for us to be able to keep it and for investors to be able to benefit from holding that asset and have more time in the market than a 3 year or 5 year, that just the traditional hold periods. And the reason most investors want out is they want their capital back. They don't want it
Hmm.
tied up for more than 5 years. And so we, with the 10-year model, we just approached it and said, what do we have to buy for from a basis perspective? And what does a business plan have to look like for us to refinance 100% of capital out in that 5-year window where it's acceptable to return capital? And it's a different buying criteria. Not every deal fits that model. But when deals do, we really like the 10-year model because anyone who's trying to defer taxable events and pick up depreciation to offset capital gains, it's great for them. Anyone who is trying to build their mailbox money flow and passive income stream, one stream at a time, it's set up to allow those people to have this deal pay them and take the same dollars and go pick up another income stream. And those are the reasons we like it. I also think if you look at business plan, a lot of operators that go in with a 5-year business plan sell in three, or go in with a three, they sell in 18 months. And it's because the market works in their favor, and they can hit a crazy IRR and hit their third hurdle, and everybody does well. And for us, we said, IRR becomes insignificant or difficult to calculate when you return 100% of capital. Technically,
Right.
it's infinite. And so it's cash on cash driven waterfalls, and investors are 60% of everything lifetime of the deal. And the only difference before and after refinance is a six pref.
Mm.
And we will get comments that that's low and lower than what they see in the market. But our reason for it is we want deals that can pay a six out of the gate, and
Mm.
we don't want the pref to be what prevents or prolongs a refinance.
Mm. And so typically you're going to have to execute on this type of model. You're looking for the deeper value add plays. Is that correct? I mean, it's very difficult to execute on that type of model on newer vintage B plus, maybe lighter value add.
Yeah, it's either mom and pop owners where you have some value add upside and management upside, and you can achieve that on an 80s or a 90s product if both of those are true, or it's the deeper value add 70s, 60s C class stuff. And we renovate 100% of units typically in that model, which would be atypical for most syndications. It's you prove a percentage of the value add component and then sell it with a built-in business plan. But for us, we look at it as every 7 years or so, an asset's ripe for reposition anyways. And so if we complete our renovation year three or year four, then you have essentially the equivalent of 100% classic when you go to sell 10 years from now.
Yeah, love it. So, talk to us a little bit about the charity side of your business. It's a unique piece that you guys have focused on. So, maybe just describe that for us.
Yeah, Braden's my business partner. We were doing the disaster consulting stuff in Florida, and it was late. I'd worked till 1 or 1:30 in the morning, and this ad pops up on what I had playing in the background on YouTube. And it's, the typical 30-second ads that you just click through and ignore. And it totally hooked me. And it was a
Hmm.
20-minute video. And it was this group called Charity Water. And the guy that runs it, Scott Harrison's extremely entrepreneurial and runs it like a business. And it's a charity that's built to, I think, solve for a lot of the things that we as consumers are spooked by when it comes to charities. What percentage actually makes it to the field, and what happens with my dollars once I put them into the machine. And so what's neat about Charity Water is they will show you where your dollars go. So we know exactly down to the geographic point on the map
Mm.
what wells our business is funding, when they're being built, when they're completed, how many people it's are benefiting from it. And it's just a cause that resonated with us. I mean, clean water is something that I think we all take for granted. And Braden and I just said, at the time, our company was Oakstone Partners was the name, and we gave personally to Charity Water, and we just said, what if we made that the business and the brand, and we get to tell this story of, hey, as these complexes are being repositioned, this is the impact you're having by choosing to invest with us over other sponsors. And it's 100% out of our pocket. It's 10% of Braden and I's gross compensation on deals, but it gives investors the ability to see the impact of just their choice to invest with us,
Hmm.
and have a feel good component to making money. I think it's something that when we talked about repositioning our brand as a business, the other piece that excited me most was investing is just this frowned upon topic. It's not dinner table conversation amongst friends. And this was a way to bridge that gap and make it something fun and approachable and exciting.
Do you have any advice for other lead sponsors out there who are already maybe they're already inclined to give to charities to help in their communities, but haven't tied that type of effort to their business yet? Do you have any advice for those that may be looking to do that, exploring that possibility, or have a desire to integrate the two?
Yeah, I would say do it, figure out something consistent. That's what's benefited us. I mean, we can point at the 10% and just say this is what it is and what it'll always be. And for us, I can tell you the biggest benefit that we've had is it's no longer we're going to go find deals and make money for ourselves. Like
Mm,
there's another driving force. And you've been in the business, and you can only underwrite so many deals before it gets old. And so we were hitting that point, and I think as soon as we connected it to giving and made it about more than ourselves, it became much easier to go solve the problems you have to solve to go from 100 units a year to 1,000 unit a year goal, and just all the problems that come with that. So I think that, and then it's opened a tremendous amount of doors on the retail investor side, on the lender side, the family office side. I mean, it comes up
mm.
in most conversations that we have. And I would say if you're already doing that, just make it public and make it known, and it's going to resonate with somebody.
Yeah, great advice. Well, look, as we start to wind down here, I've got a few final questions for you. The first is, what's the biggest challenge that you're facing right now in your business that we could all learn from?
Um, I would say interest rates are something. I mean, that's just today, and it's less so our ability to vet deals. I mean, it's harder to make sense of deals with today's interest rate environment, but I think the larger issue that we've seen is investors watch the news, our passive investors do, and there's a lot of fear-driven media right now, and a lot of people are electing to stay on the sidelines. And so for us, it's just going through the process of educating, because I do think this is potentially one of the more lucrative times to be in our space if you can find the right deals and plant seeds and be in a deal and in the market for the rent run that's probably about to take place. But it's helping people overcome their limiting beliefs that are keeping them on the sidelines. And I think that's something where we're trying to balance, not being salesy or pushy, but also educating and just making sure our investors are aware that what's being stated on the news or online or wherever they see it isn't necessarily what's going to be true in this asset class in this upcoming period.
Last question for you. What's on the horizon for Well Capital? What is the vision for your company moving forward?
We, from a giving perspective, we'd like to bring clean water to 1 million people, and that's the goal. And so we backed in to what it would take to get
Mm.
there, and it's probably going to be somewhere north of 600, 700 million in assets under management. And so I think the goal short term would be 1,000 units this year, and then to continue to build on that. Ideally, 10,000 in 5 years, but we understand the market's going to do what it's going to do, and we just want deals that make sense. And and benefit our investors. So
I think it's cool that you went to the charity side of your business. What are you trying to accomplish from the charity side? And then built your economic model for your business off of that goal. And that's pretty cool.
thank you.
Well, look, Preston, this has been a great conversation. I've enjoyed hearing about your business, your background, how you guys got into the space, and sort of a unique business model as it pertains to your 10-year hold period with the goal of refinancing, returning 100% of your equity back. Talking about remote investing, where the importance, where you place high importance on the joint venture partners that you have involved in the deal and the property management companies that you're working with locally. And then also talking about your charity and the impact that that's had on your business and focus and drive for moving forward in your business while also doing good. And so it's been a great conversation. I've enjoyed hearing about your business and look forward to staying in touch with you down the road. Before we let you go, what's the best way for our listeners to connect with you and learn more about what you have going on?
Yeah, www.wellcapitalinvest.com. That's our website, and it's got charity water links. It's got our investor portal link. Everything can be found there. My phone number is there if anyone wants to reach out.
Great. We'll have that in the show notes. So if you're listening right now, go down into the show notes, click on one of those links to connect with Preston and his team. Again, Preston, thank you for coming on the show and sharing with us and our listeners. And we look forward to chatting with you again down the road.
Yeah, thanks, David. Had fun.